Hey everybody, this is Brant from Wolf on Wall Street Trade with the market update for the week ending September 27th, 2019. Before I start, I just want to say if you don't get my updates every day, if you're not a member, not a subscriber, I would recommend going out and checking last week's video, and I'll put a link to that in the description below. And the reason is it provides some continuity and context, what we were looking for, kind of what happened, and it just tells the story as things go along. This is a weekly chart of the S&P 500 as of last week, the end of last week. And what we basically saw was some inside weeks. So this real body was inside of this real body, which is the loss of momentum. We also saw some resistance right up here at these two weekly candles, and that was the S&P 30/20 level. There had been three failed bull flags last week up here at this resistance, but really on the whole, the week kind of just ended up as a consolidation week. And a few things were turning negative, like the outlook in currencies. Yield curves were starting to flatten. And I ended last week's video asking, what is crude going to do? That's an important thing. But more importantly, what are treasury yields, our bond yields going to do heading into this last week? And we got the answer really quick on Monday morning. They dropped by about 5 basis points Monday morning. That was a big move, a very negative move for stocks, but the S&P closed just about unchanged on Monday, which sets up a really nice opportunity to sell or short the S&P. Quite frankly, I think someone knew that this whole impeachment push against President Trump was coming on Monday, knew it before other people, and were reacting. Running through the averages real quick on the week, the S&P 500 opened the week right here, closed down about 1%. It pierced right below the 50-day moving average on Friday and closed back above. The Dow Industrials were the best performing on the week, relative strength. They were down 0.4%, closed well above that 50-day moving average. And then small caps, which were the best performer the week before, were the worst performer this week, down 2.75%. That was IWM's worst week since May when tariffs ramped up again. It closed below the 50-day moving average and actually just a little bit below the 200-day moving average. The last 2 weeks, price action has been singing. Look at this price action. Bullish flag failed, right? Another bullish flag, a weaker bullish flag. All these failed. Bullish, bullish, bullish. And then moving into the end of the prior week, bearish flag, bearish flag. This is coming into this week. And then prices really started to break down. So you see the transition, even though if you look at prices without any kind of trend lines, it just looked like the market was kind of going sideways, real rough and volatile. And you can't really get a good feel for what the market's doing. Add in those trend lines, you can see it is bullish, bullish consolidating, bearish. On this 5-minute chart with the trend lines from Friday into Monday over here, the 23rd, I added the 10-year yield in white. So you can see what it did. It plunged Monday morning on the open. This, I believe, was about the political risk. I think somebody in Washington knew that the congressional Democrats were going to start an impeachment hearing against Trump. So here was the opportunity. Prices dropped down and then consolidated back to unchanged, but yields were really 5 basis points lower. This was screaming a sell up here. This was a bear flag. There's Tuesday morning's open, and here's the decline. And this was my first measured move downside target on Monday and Tuesday for a move about 0.5% lower. It met that move on Tuesday over here. You can see another bear flag intraday, and then just blew through the target again down here. For the first time in a long time, I saw the market react to U.S. domestic politics. I haven't seen that in a long time with all the Mueller report and stuff like that. But what I saw was Wednesday morning, the market had come down a little bit. Then yields started moving up. As soon as President Trump released the transcript of his phone call with the Ukrainian president, the market breathed a sigh of relief. Bond yields jumped up, and the market kind of consolidated the rest of the week. It's the first time I've seen the market react to U.S. domestic politics. It's overlooked a lot of stuff. It was very concerned this week. Like I said, that's why I think yields fell so sharply on Monday morning. I think somebody had a heads up, knew about it before it happened, and then there was this relief rally. So here we come into Friday. This is a bear flag. I had a downside target. Quite frankly, that still has not been met yet, but this is a key level at 29.44. And Friday we came right down just like less than 0.1% away from that level. And the reason I'm paying so much attention to it, and I think it's significant, is that you can see this entire August range, this big, nasty, choppy range. That level, the breakout in early September, was basically 29.44. Like the NASDAQ, the S&P is close to retracing all of this September rally. So again, this is a lot of trend lines. But if we take all these out and just clean up the chart, this is what the last week's trend looks like. Here's that failed bull flag breakout at resistance 30.20. This was the FOMC. They cut rates by 25 basis points. The S&P initially knee-jerked down, then rallied up. But the reaction in the dollar, in treasury yields, and in gold was all negative. Stocks initially dropped and then rallied. The other assets did not buy it. So only stocks bought it. And from here on that Thursday, the next day after the FOMC, and at resistance, you can see this is what's happened. All those bear and bull flags in this whole area resulted in this downtrend. It is a minor downtrend, but it is a downtrend. We see price making lower highs, right? And lower lows. Over here, and over there. That's a downtrend. Although the S&P 500 was only down about 1% on the week, these were huge swings of about 1.2%, about 1.8%. So for traders, these were pretty nice swings that you could take advantage of once it became clear that we had this downtrend. And this transition from bull flags to bear flags basically told us that something uglier was coming, like this downtrend. And the price trends were similar for the other averages. So here's the Dow, again, downtrend channel, minor downtrend above support over here. Didn't quite make it down to the bottom trend line on Friday. A little bit of relative strength in the Dow. Here is QQQ or NASDAQ 100. Again, downtrend channels. You can see lower highs, lower lows, and a lower low over here on Friday. This is kind of a key level, in my opinion, for the QQQ, right around 190. And let me show you a different perspective. That's 15-minute chart. There's the downtrend. And let me go out to a 60-minute chart. So this is a big, it started off as a big bear flag, but it's just a little bit too extended to be a bear flag at this point. But still, it has a bearish consolidation. The concept is the same, just a little bit too big. Closed below this trend. And here's the 15-minute trend for QQQ like the others. Bear flags, right? Bear flags. So IWM, again, lower highs, lower lows, closed at a lower low for the week, bounced a little bit into Friday. It did not meet my measured move target as of Friday's close, so it does have a lower target from these bear flags down here around 149. On a daily chart, this has been weak relative performance by small caps. That picked up a couple weeks ago, so this is the whole initial breakout and bullish flag up here, and this is the failure the last 2 weeks. So failed again at this trend line, or really right in here where we have like 1, 2, 3, 4 failures right around that 159, 160 level. And last week, I think it was last week, I touched on relative strength, IWM or Russell 2000's relative strength against the S&P 500. And what I had mentioned was it topped back here in 2018. It is well off new highs or record highs like the S&P has made a couple this year. That's bad news when small caps are lagging. So here's the relative performance. So all of this strength over here a couple weeks ago, all it did was revert back to this relative weakness downtrend. The last couple of weeks, NASDAQ has been showing relative weakness, and especially this week. Look at it just tumble. Here's the Dow on a 60-minute chart, and over the last week or two, notice it is strengthening versus the S&P 500. S&P sectors this week, all 8 cyclical sectors were down. All 3 defensive sectors were up. Some of the worst performing were energy down 2.7% on the week, communications down 2.8%, and healthcare down 2.9%. Here's healthcare down 5 days in a row. Ugly candles. Elizabeth Warren overtook Joe Biden in the polls. And the healthcare sector sold off because Elizabeth Warren is campaigning for Medicare for all. And in its most extreme form, it could end up doing away with private insurers. So that is why this sector got hit so bad. Just to give you some flavor, these are the sectors on the week, actually from Friday the 20th. So here is this week from the 23rd. This is materials, bear flag here, bear flag. And that has just broken down on Friday. Here is the energy sector, bear flags, broke down through that bear flag on Friday a little bit. Has not met the measured move. The financial sector down just a little bit this week, so it's acting better, just above this downtrend. And then we have the industrials and the technology sector, so selling off into the week. Bear flag, a false breakout up at this downtrend channel, comes down. That is a break of that bear flag, and it comes up here in a little bull flag around Thursday. Looked like it was going to try to break out from this downtrend channel, and again down. And you can see those bear flags, or the transition is apparent in all the S&P sectors as well. Last week I talked about relative strength in volatility. I talked about VVIX in particular. So here's what I want to point out. Look where VVIX is in early September. It comes right here to about 90. Look where it was back in July and early August, way down here. Now compared to the S&P 500. The S&P 500 in early September rallied almost up to that late July high. So if VVIX was acting normally and was not showing relative strength in early September, it would have been down here. So that is a relative strength. And that can be seen with these trend lines as well, what has developed into a big bullish flag. And VIX doesn't look as strong, but it is similar. Has not retraced all the way back down to those July lows. So there is some relative strength there. VIX was up last week. It gained another 12.4% this week. That means VIX is up 25% over the last 2 weeks. And let's go to a 60-minute chart. S&P 500 was making lower highs, lower lows. At the same time, VIX is making higher highs and higher lows. Look where it ended on Friday, just breaking out above that flag kind of consolidation. The market has been pretty quiet. It's been pulling back, but it's been doing it orderly the last couple of weeks. If this breaks out, that all changes. Touching on currencies real quick. This is how I left off last weekend's video, that the S&P was up here, but some currencies had went risk off into the week. So this was one of them. And since then, here's what's happened. Prices came down this week in this downtrend channel as we talked about. But it was in fact this currency that gave us a warning while stocks were up here that there was trouble, and that's what we see going into last week. In last weekend's video, I showed the Aussie versus the US dollar. This is what it looked like with a bearish consolidation heading into this last week. Down, another bear flag, down, another bear flag. That is a bad look for risk assets going into next week. This is what the dollar yen looked like heading into last week from last weekend's video. Bearish descending triangle. So look at the bearish price action. Bear flags here, bear flags here. Towards the end of the week, it actually did improve, which was interesting. And the final currency high on my watch list I'm going to leave to the end of the video. And one other thing I left you with last week was crude oil. I use USO. There was this big spike, 15%, biggest spike intraday in crude's entire trading history. That was on the attack on Saudi oil facilities. Last weekend's video, I said, look how this ended the week with a bear flag. Not a perfect bear flag, but a bear flag. And this has really been a key support resistance level in 57, 58 for WTI crude. Into this week, crude breaks down. So here is the bear flag. Here's the breakdown. My measured move target was actually lower. So crude lost about 4.5% of the 8% downside target that I have. So it has pretty much about 3.5% more just to fulfill this bear flag. All of this 15% spike on Saudi Arabia losing half of their crude output has now been retraced. Touching on gold quickly, last weekend I had shown gold. It was basically holding this lower downtrend right in this area, which is about $1,500 for gold futures. And I had been seeing a lot of buying activity right down here at that 1,500 level. So this week it kind of moved up very constructively and then dumped. And that was part of the sigh of relief by the market. Once that Trump transcript was released, the market kind of said, well, it's not as bad as we thought. So the safe havens like gold were dumped. This I do not like at this point. The way gold is kind of hovering around that 1,500 level, it almost looks like a little head and shoulders top. I don't think it really is a head and shoulders top, but it does look more bearish in terms of price action. And the reason why is quite simple. Made higher highs, higher highs. This is not a higher high, it is a lower high, and we have equal lows over here. I'm just saying I don't like the fact that it did not follow through here and make a higher high. So this, I would watch very carefully at this point. I will update gold for members. I would certainly consider putting a stop in place somewhere a little bit below that $1,500 level. So let me try to wrap this up, put it all together. This is the early August sell-off. This is a 4 or 5 week consolidation. Here is the 29.44 level breakout. This is pretty much September's trend. Resistance here 30.20. This is the FOMC, this bounce in stocks. But remember that the dollar, yields, gold all said it was bearish or hawkish. So stocks bounced for one day, hit 30.20, and this is what they've done since in a downtrend, minor downtrend. So they're still above this 29.44 level. And that is why I've been talking about it really all of September, actually before that, as being a really key level. Closed right down to it on Friday, and it is right here at the same level as the S&P 500's 50-day moving average. On Friday, the S&P made a lower low, held above 29.44, but it has not met my downside target. Members, you know what that is, and if that is met, we will break 29.44. In the very short term, this is obviously a place where we expect to see some kind of attempt to put up some support. For the Nasdaq's part, it ended the week making a lower low. So this pattern of lower highs and lower lows is still intact. Small caps look like they were going to try to put up a defense over here at the 152 level. Ended Friday making another lower low and below this 152 level, which I think is really a big development. This is the trend right now that's in effect for almost 2 weeks. It is a downtrend. Lower highs, lower lows. That has not changed. From 3C's perspective, last week we ended the week, remember, this positive divergence right here into the bottom of the FOMC and this rally. This is resistance for the S&P, for a lot of the other averages. And this is coming into the week. Here's Monday. So 3C really deteriorated coming into this week, negatively diverging with price here, and that's the reaction, lower. You see a very small positive divergence here, a bounce, and into Friday we still have a very small positive divergence. For the SPY on a 1-minute chart, here's that same positive divergence at the FOMC, the rally, and kind of faded that. A small positive divergence here on Wednesday and this bounce. And if we zoom in a little bit closer, we'll take a closer look at how Friday ended. So small negative divergence here, small negative divergence here, price comes down. This is how we ended Friday. So we do have some small positive divergences. That's a bounce right here late in the day on Friday into the close. So taking all that into consideration with the S&P here 2944, we do have those moving averages in effect. IWM at the 200, S&P at the 50-day. I would think we get a little bounce early in the week. Maybe we come up to test this channel again. The 3 most important charts heading into next week. Number 1 is right here, S&P 500, 2944, 50-day moving average. Number 2, big move in VIX, 25% move, so it is due probably for some kind of correction consolidation. What I want to point out is on Friday afternoon, a little probe above that, almost breaking out, and this is because the Trump administration said on Friday that they are considering putting capital controls on China. And finally, the most important chart in my view is the US dollar against the offshore Chinese yuan. If you go back to last weekend's video, I talked about the 713 level. So going down is positive for risk assets like stocks. That means trade tensions are dialing back. Going up, which has been happening the last 2 weeks, the same time the S&P has pulled back in that downtrend channel for the last 2 weeks, is negative for stocks. It means this currency pair is saying we are worried about the trade war. And this is the level specifically I mentioned last week, 713. Watch what happens on Friday. This move in this currency means that the FX market, the market is getting worried, getting more anxious about the entire US-China trade deal, trade talks, trade war. And finally, while I don't see it as impending trouble heading into next week, watch those Treasury yields. Over here, they did not make the higher high with the S&P, suggesting that this bull flag breakout at resistance would fail. And then we see this again Monday of last week. Yields down, stocks ignore it, they move up. Yields were right, stocks were wrong. Stocks spent the rest of the week going down. So what we do want to watch for next week is what do Treasury yields do? Moving up would be bullish for stocks. Moving down, especially when stocks are moving up like over here, bearish. And a good opportunity for traders. From a very big picture perspective, nothing has changed. We still have this very big broadening top. We have 5 pivot points, 1 here, 2, 3, 4, and 5, and that's usually what you get. Haven't touched this upper trend line again. We did touch it back here in July, so that's about 30-50 or so. I think your upside is very limited, and you have a whole lot of downside below. That will do it. Thanks for listening to the video. If you enjoyed it, please let me know. Give it a thumbs up. Feel free to leave comments, questions, any ideas for future videos in the comment section. There should be a subscribe link down here in the bottom right-hand corner. You can subscribe to my videos. You can also follow me on Twitter, and I do have some free posts a couple times a week on the website.